Welcome. Welcome to Cost Accounting. We are going to start with Chapter 1, and Chapter 1 is going to form the basis of everything that we lay on top. Cost Accounting, information for decision making. In this chapter, once you have read it and also completed the homework and other activities, you should be able to describe the way managers use accounting information to create value, distinguish between the users and the uses of a financial and a cost accounting information, explain how cost accounting information is used for decision making, and some trends that are very, very specific to cost accounting. Also, some ethical issues that are very, very much something that you need to consider as you progress in cost accounting, whether it be professionally or just in academics. Well, we want to know, how can we add value to the organization? As you know, most of us CPAs, accountants, we don't generate revenue per se, unless we're a CPA firm, of course. So we don't generate revenue, but we need to be able to help our managers and leaders of the companies that we represent make some very useful information and add value for the organization as a whole. And there are so many ways we can do that. But let's talk about just adding value. What can we do to add value, and how we use that value to create opportunities for cost management within our firm. So we want to talk about activities that transform some raw materials into resources and goods that we can be used to purchase for others. So how do we add utility to these? Well, obviously R&D is going to be designing and all types of things, but what we want to think about is we want to talk about research. We want to talk about how we market, how we produce, and how we work with our customers, and how we add value in doing that. So what we're doing for a living, if you talk about a manufacturer like Kellogg's is not only manufacturing a product that is consumed but it's also adding value. We're adding good products that people want, people like, people enjoy, but won't kill them. So we really want to make certain that we're doing a good thing, we're doing a wonderful thing, but we're also adding value to the organization as well. So accounting information. I would assume because you're taking this course, you already have financial accounting, you already have managerial accounting. So you know financial accounting is about a set of rules, gap center, recording revenues when earned, recognizing expenses as incurred, systematic allocation of a cost, meaning depreciation, systematic allocation of an intangible asset, amortization, depletion, that sort of thing. So we all know those rules. And they are solely for the point of financial position. How well are we doing? If we are doing well, are we profitable, basically? But cost accounting has a very different perspective. Now, don't get me wrong, financial accounting is very, very important. But for right now, let's take a look and let's follow this journey down the road of cost accounting and what it can do and why it's so important for organizations to have an effect in the cost accounting system. Because it's all about costs. How do we track costs? How do we use costs? How are costs important to the organization, and how we can properly manage them to add value? So financial accounting is going to be providing information to external users, creditors, investors, and others. Financial information is prepared in accordance with GAAP. Clearly, we know this. Let's talk about cost accounting, because that's really the most important. So we care about people who are external for financial reporting purposes, but what about people from the inside? What about internal users? Well, they want to make the best decision possible. Now, if you think about Kellogg's, for example, Kellogg's wants to know who needs our product, how can we get that product to them at a price that they can afford. But in that process, managers are saying, okay, we know what they want, we know how much they'll pay for it. Can we streamline our organizational process to add the best value to them, but also make certain that we can evaluate how well that product, whether it's honey bunches of oats or frosted flakes, those products, we want to evaluate those individual products, make certain that they are priced effectively, that they are giving us a return on our investment, that if we can make some improvements, or if a certain area of the country likes that type of cereal, and another area of the organization or another part of the country likes that cereal. We want to be able to get our products and our specific products to the people who want it in the most efficient way possible. Cost accounting allows us to do that. Among many different types of decisions that need to be made, this is just one. So how can we help them make decisions? We can provide performance. How do we determine how well we're doing? How can we make a decision on the information that we're getting. What does it mean to us? How meaningful is this data that we have been compiling? How can it guide what we do and what we don't do, how we price and what we don't price, or what products we keep and what products we remove from our shelves? It's all about decisions. I mean, it just depends on the who we're talking to. If we're talking to managers of the department, we're talking to the production department, we're talking to the management department, which is the administrative. We want to be able to give them good costs for their decisions. We want to help them to make decisions about controlling costs. And also any other type of decision. Again, a lot of flexibility. If you can notice that in financial accounting, it's a lot of strict rules. Well, in managerial, it's a lot of flexibility here because it's really depending on what kind of questions we're asking, or what kind of assistance that we're providing to those individuals who are looking at our numbers. So, cost for decision making, helping us expand and grow our organization if necessary. Can we decide on different types of information to whether or not we're going to break even, whether or not we have a margin of safety? How do we evaluate our standard costs versus our variable costs? How are we going to handle our variances? All of that. How should we expand? Can we expand? If we decide to expand, what would it look like? Sensitivity analysis. All of that is all about cost drivers and using cost information to help decisions. So, here's our cost, here's our driver. And again, we're talking fundamental concepts in this chapter. So don't worry about a lot of different terms that don't make any sense right now. They will, because we're going to use them again, and we're going to use them in context of various types of decisions that a manager will have to make. And we'll be using us to help them make that decision. So understanding differential costs and costs that change to a different course of actions. They change between actions. So again, another term that's very unique. It's okay. We're learning we're learning new terms. Again, like principles of accounting, financial accounting. There's a lot of terms in this chapter and in other chapters that you're going to have to learn and understand how to use. But remember, in this course, fundamentally, we're going to be talking about costs that relate to managerial decisions. So with that in mind, always remember it's all about our internal managers of the organization, where we're directing all of these concepts and why they're important. It's going to be important to them. So, and this illustration here is just giving you differential costs, revenues, and again, the difference. Very, very basic information, but I think this particular narrative here is just really putting it in perspective. When you look at our organizational financial statement, in this case an income statement, costs like this don't appear this way. You'll see your revenue, you'll see your cost of sales, right? Then you'll see your gross revenue, then you'll see your operating expenses, then you'll see your non-operating expenses, then you'll see your bottom line. This is very different, and you're going to notice that when we look at reports that similarly look like a financial statement but really doesn't. That's because managerial accounting is not really emphasizing the financial reporting side of it. They're looking at how can we control costs, track costs, report costs, and using information in various different ways to make decisions internally. So we may very well take a little bit of our financial accounting concepts, but kind of modify them to meet our needs. That's why managerial accounting is a lot of fun, because you're really not stuck to a whole lot of GAAP rules, and you can make a lot of decisions based on information that you need. And not all information that managers make in the cost accounting area are financial. Some are non-financial information. You use financial information and non-financial information to make decisions, and you're going to see that as we go over time. So cost for control and evaluation, a responsibility center. I don't like using responsibility center because it's really not a word that's used in real life, but I would say a division or geographical location or function. These different type, or responsibility center. All of these mean the same thing pretty much. These are areas where they want a very specific type of information relevant to their organizational section or their division or their geographical area, or their, in this case, we can talk about organization creating Frosted Flakes. So they'll have one division that's all they do is create cereals. And then one division will create canned foods, for example, and another division will be creating products like bars or protein bars or different types of things like that, or different dessert items. Again, when we're talking about cost control, a responsibility center could very well be very different depending on the organization, how they decide to term that. It could be a division, it could be a location, it could be a product line, or it could be a specific function. Either way, we're talking about responsibility sections, and they are assigned to a manager who's accountable for those operations, basically. So if you're looking at this little mini organizational chart, you'll see the president and then vice president and so forth. It's really like that. Each one of the organizations have a different way of using responsibility centers and what they call them. But in the end, it's a very specific area with a specific type of function or area or a location where they are going to be controlling, monitoring all costs and revenues within that particular area. So we are going to think about notations from the income statement. Again, if you talk about manager salaries, we're going to talk about excluding president's salary. We're talking about difference in revenues and costs to a specific channel. I would say to you, when you're reading through this chapter, you make note of the following things. One, the difference of terminology, the difference of emphasis, the difference between financial accounting and what they look for, and cost accounting and what managers look for, because that's going to really be something that's going to be talked about and assumed in chapters that follow. So if we're talking about tracking bakery sales, a financial statement wouldn't look like this. Financial statement would only have the major headings like sales, etc. But when you're talking about how to budget costs specifically to a baking division of an organization, ingredients matter. The specifics of the ingredients matter because we want to be able to track specific costs. Where in financial accounting, you would be looking at a higher level, will be more on the revenue side. How much do we make in revenue in terms of our bakery goods versus our other goods, canned goods, for example? Do you understand the difference? So when you see these different types of analysis, remember, cost accounting is tracking costs, and sometimes the cost can be very specific as the ingredients that make up that whole. Okay, so think about that. Trends in accounting. What is happening in cost accounting right now? We're better able to help with R&D before a product is even actually launched, in the process of getting it to production. We are involved with designing, again, identifying costs associated with the design and the development of those products. The purchasing department. What do we purchase? How much do we purchase? And for the cost that we purchase on those items, and identifying how much we need to spend during that production process. How we market that. Again, detailed costing of how we market our products and how we get those products to our consumers, the distribution and customer service. Again, these are different trends. How do we deal with that? How do we deal with, or how do we track it? How do we report it? How do we manage it? How do we control it? All of these are, again, about lean manufacturing. How do we utilize our manufacturing process in such a way that we utilize absolutely everything that we need and nothing more? There is little to no waste. That is what I would consider lean manufacturing. Cost and design. How do we design our products? How do we put together specifications for a specific product design? And that is going to be designed for manufacturing. Again, ABC costing is a very big one because it really does break down costing by the activities, and you can truly see how things flow. So when we manage our accounting and our costs in accounting and purchasing, we want to make certain that the process is working well. So we want performance measurement. And again, a lot of flexibility here. We'll talk about any details. Right now we're in overview. How do we minimize unnecessary transactions? How do we benchmark? Meaning, how do we take our costs and measure it against something, our benchmark, and how well we're doing it in assessing performance. So we're not going to be finding a place to sit and say we are here. Cost accounting is much more fluid than financial accounting. It is how we are working through a process and how we continually improve. So again, as I mentioned before, just-in-time inventory system is going to be very, very critical in cost accounting because we are not going to have a lot of inventory. We're going to have just enough of inventory on hand to get the job done. And it requires tremendous care when you're doing your budgeting, when you're actually determining how much do you need to have in your inventory to meet that particular process or that production process. So cost accounting is very important. In relationship management, again, a process of us learning how to establish relationships with our customers and using that information to develop better, more profitable revenue and customer service. So outsourcing is also a process that can be done, and that means that, for example, if we use Kellogg's, we'll say Kellogg's is going to outsource the manufacturing of their cereals. That's when we say, I'm going to let someone else do the work. And before our organization make a decision of that magnitude, they're going to have to do some sensitivity analysis. Again, cost management and a sensitivity management to see if it is cost effective, if it's going to, what kind of impact it will have on our bottom line, on our profits. So cost accountants really work well with financial accountants because we let them know, well, if we do this, this is what it's going to look like. This is what it's going to look like on the financial statements. This is what it'll look like when we try to evaluate our revenues. This is going to look what it's going to look like in our budget. So we are providing very, very useful information. And again, outsourcing is an option. But before you make a decision of that magnitude, you got to do some costing. You're going to have to make certain that you are able to know, in theory, what will be the impact if we decide not to do the work but to give it to someone else. Because it's not always a profitable opportunity. Sometimes it actually costs more money to outsource. So cost accounting, again, will be helpful in that. Total quality management. Again, accounting and customer service. Not everything in cost accounting is going to be financial. Some are non-financial criteria, non-financial ways of evaluating. So again, with this chapter, we're just going to see really how all of this work together, how we're going to link these processes in order to have a comprehensive way of evaluating our organization. Key players in the organization very much going to vary, and the titles by which they are used are going to vary, but in essence, the responsibilities will be the same, just the nomenclature. So don't get so tied down to the actual position title. More so, I would lay emphasis on the responsibilities. So as cost accountants, we want to make certain that we're doing really the right thing in the right way, truly. And it's actually more important to note that it's not just being legally correct, it's going to be morally correct. We don't want to do anything or provide information to individuals that's going to be misused, or it would defraud our customers or our shareholders. So we got to be right, we got to be fair. So making certain that you discuss any conflicts of interest. If you're working with a client or you're working with a particular process that may very well be a conflict, discuss those. Make it clear. Bring it out in the open so that you can either be given another opportunity to work on another project maybe, or maybe there's something there that you can work through. But in the end, clarify your issues. Make certain that you work with an attorney, and also, more than anything, discuss it with your direct supervisor. We want to make certain that we're doing the right thing in the right way. The Sarbanes-Oxley Act was most certainly to address governance. Governance meaning people at the top doing the right thing and making certain that they set the tone. And it also is all about accounting firms and corporations. It may not affect all entities. Private organizations may not be affected, but we can use that act as a guideline to help us establish controls, establish procedure, and allow for whistleblowers to be protected, and corporate responsibility. So again, we want to make certain that we have the people up on the top, the higher ends, doing the right thing, doing it and setting the tone for everybody else. Competence, confidentiality, integrity, and credibility, all important part of an ethical perspective. And you want to see that in your organization, and you want to most certainly see it in the people working with the organization. Being competent, knowing you have the expertise, knowing you know how to do the work, being able to keep information private unless disclosure is authorized. Very, very important. And then being honest. Don't have inappropriate relationships or entanglements or financial commitments with other organizations that are in competition with your job, with your company. Be fair. remove yourself from those type of situations. If you feel that you're in a conflicting situation, immediately report it to your supervisor. Make certain it is aware of that. They are aware of it, and they will give you another opportunity, another company to work with, so that you won't have a conflict. Being honest and making certain that the information is objective. We don't want to put information in our reports that's unfair, that contains some sort of bias. We want relevant information given to them. And we want to make certain that we're timely in giving that information. And when we do communicate it, that they can understand it and can make a responsible, sound decision based on it. Thank you very much for this first chapter. I think you'll like it. Take care.